look at the performance of various asset classes over the past 5 years, we've ranked them from highest to lowest in terms of annualized return over the past 5 years. So global equities unhedged have produced returns of 15.7. Hedged global equities just over 13%. Composite bond index in Australia 6.6, slightly above that of the ASX 200 Accum, which has done 6.55 ahead of bills. So the Australian equity market has performed basically in line with bonds and also quite considerably below both hedged and unhedged equities over the past 5 years. Now I just want to have a very quick look at correlations between the asset classes, and if we choose monthly change in the ASX 200 and looking at monthly change in global equities, and we are going to be looking at the last 120 months. So over the longer term, the correlation obviously between Australian equities and global equities hedged has been quite high at 0.82. We can see this when we look at the rolling correlation chart. It's steadily increased from about 0.7 up to 0.8, 0.9 to be 0.82 over the past 10 years. So it looks like the Australian equity market is highly correlated with global equities in hedged terms. However, when we consider more recent time periods, and we already alluded to the underperformance of Australian equities, I'm just dropping the term now, looking at rolling 56 months. Let's just take it back. If we take it back to about the last 18 months, we can see that the correlation of monthly returns between Oz equities and global hedged equities has dropped to around about the 0.4 range. And has sustained these lower levels for quite some time. And this is unusual. We really haven't seen that possibly since the early 90s when Australia was in the midst of a recession or just coming out of a recession. And this follows a period where the regions, Australia and global equities, have been very highly correlated from about 2005 through to 2012. So obviously over the past 2 to 3 years, a key consideration for the Australian equity market has been the decline in commodity prices, iron ore and the mining sector, which is a sizable part of the domestic market. If we look at another way of looking at that is to look at the relative earnings cycle. So what we're doing here now, we're comparing Australian equities relative to global equities, 6-month change, that's the purple line. And that's on the left-hand scale. So you can see this is underperformance. That's the zero line, so underperformance here. And the gold line is the relative earnings revisions of Australia versus global and US equities actually in particular. So you can see that broadly, although volatile, certainly the earnings revision number is volatile, but it's the relative performance of the two regions is pretty much reflected what's happening on the earnings side, although we have had periods where earnings were being upgraded here in Australia, yet the market did quite poorly. So clearly the earnings revision cycle by and large has been a negative for the Australian equity market relative to global markets, although more recently you've seen it tick up a little bit, but it's still not consistent with a strong outperformance of the local market. And another indicator to look at will be, once again, we're looking at global or domestic equities relative to global equities. The red line, that's 6-month change, and that's on the left-hand scale. So during this whole period here, since 2010, really, the domestic market has more often than not underperform global equities. The blue bars alongside that looks at the relative business cycles. If you measure the business cycles by the NAB Business Conditions Index compared to the ISM index, I'm looking at deviation from average. That is the dispersion between the two, looking at a Z-score there. And what we find is, once again, similar to the earnings revision cycle, this seems to pick up the broad contours of performance. If we look at the period from 2009 through to 2014, mid-part 2014, generally the Australian cycle on this basis has underperformed the US cycle, and likewise so have Australian equities. The opposite was true during 2005, most of 2004 through to about 2007, when the Australian business cycle, business conditions outperformed the US cycle, and likewise back in the early part of the 2000s. So where we sit at the moment is an interesting juncture. The equity market here has obviously underperformed again by, say 5% over the last 6 months or more. Yet the relative business cycles have improved. The US cycle has tipped over somewhat, but the Australian cycle has probably somewhat surprisingly, despite that, the headwinds from earnings and mining sector in particular has fallen away. So this would normally suggest that the Australian equity market could do a little bit better, although, as we said, we're yet to see that flow through to earnings.